Hello friends, this is Team SuperSimplified and today we are here with Economic Survey 2017 Chapter 4. So let's get started. The title of the Chapter 4 is The Festering Twin Balance Sheet Problem. Now what is this twin balance sheet problem? And which are the two balance sheets we are talking about? First is the balance sheet of the companies which have taken huge loans in the past, but their present financial performance is not up to the mark and hence they are not able to repay the loans. And second balance sheet is of the banks which have given these loans and their balance sheet is burdened because of the bad loans. For them, it is a non-performing asset. So the financial position of both the provider and the receiver of the loan is under stress, and this is the cause of concern for the economy because the lending institutions like banks and the corporate sector are the backbone of the economy. Any downfall in these areas will definitely have a huge and long-lasting impact on the growth prospects of Indian economy, right? That's why an entire chapter is dedicated in Economic Survey to discuss this issue. In this chapter, we will see what are the various issues caused by this problem and what has the government done in the past to overcome this challenge and how effective were those strategies and how should we shape the future policies in order to resolve the twin balance sheet problem. Right? So because of this basic problem, there are some other issues which have originated because of this, the repercussions. So basically the NPAs are growing now and investment and credit growth is falling in the country and economic development is hampered. So we will go through these points in detail in the coming slide. Now let's understand the present scenario. What is the NPA status in the country? So Economic Survey says that the concentration of bad loans is mainly in the public sector and the overall non-performing asset level has reached around 9% of the total lendings, right? And NPA of the public sector, if you see, then it is around 12% of the total loans. And the most important point here is the 40% of the debt is owed by the IC1 companies, the companies which have the interest coverage ratio less than 1, which means they are not earning enough to even pay the interest on the loan which is taken. Right? So this is the state of the economy. So 40% of the debt is lying with these companies. So there's a very low probability that it can be recovered back. Now let's go through these two graphs. What are they telling us? So on the y-axis you have the percentage of NPA, the percentage of loans which are categorized as NPA out of the total loans given by the bank, and on the x-axis you have the financial years, right? So you can see here from the year 2014-15 onward, the NPAs are rising very sharply, right? And the red line represents the NPAs of the public sector banks and the black line is actually representing all the banks put together. So the share of NPAs with the public sector banks is actually much higher than the other banks, right? And coming to the second graph, it shows the share of the debt owed by the stressed companies, the IC1 companies. So we can see here that around 40% of the debt is lying with the IC1 companies as of 2017 financial year. Now let's understand the severity of the NPA problem. So is it really a critical condition or can it be controlled easily? So to understand the severity of the stress due to twin balance sheet problem, let's compare India with its peer countries. Okay. So here on the y-axis you have the NPA ratio and on the x-axis we have plotted the countries. So here you can see that the red bar graph on the extreme right represents India and we have NPA ratio of around 9.1%, and the other countries like Korea, South Africa, Russia, China and Brazil all are below us except Russia. So this is a very critical condition and it is much higher than our peers. You can compare with China, it is just 1.7%, and our NPA ratio is higher even than the peak levels which were seen in Korea during the East Asian crisis. So India's NPA ratio is higher than any emerging market and most of our debt lies with the IC1 companies. This is a major cause of concern that the probability of recovering these debts is very low. Okay, so now we understood the issue. We know what is the twin balance sheet problem and what is the severity of it. So now let's come to the root cause. So let's see how everything has started, what went wrong and when did it go wrong, right? So the origin of the twin balance sheet problem lies in mid 2000s. The GDP growth rate was around 9 to 10% at that time. So it was a boom period basically and the corporate profitability was very high. So they hired aggressively and which led to the increase in the wages. And as the businesses were feeling confident, they thought of expanding. So they initiated new projects and for the new projects investment was required. So the investment was financed by debt, internal and external, within the country and from outside. So the debt liability of the firms actually increased during this period. You can observe in this graph here, here we are showing the gross capital formation as a percentage of GDP. So in the mid 2000s, we can see there's a sudden spike in the investment to GDP ratio, right? So investment was rising very heavily. So this was the good time for India. The GDP growth rate was very high and the corporate sector was making money. So everyone was happy. But then suddenly the bad time started. So there were a lot of projects which were sanctioned during this period, but there was a huge cost overrun in these, and mainly because of the delays in environmental clearances or the land allotments, etc. So because of these unexpected delays, a ripple effect was generated, and because of the delay of one project, another project was also getting delayed, and the revenues were far less than what was forecasted during the application of the loan. So because of these reasons, the business was suddenly down, and the capacity of these firms to repay the loan came down drastically. They were on the verge of defaulting. But that was not all. Even worse times were ahead, and during this time, two major events took place. The first one was RBI increased the interest rates to control the inflation. So they increased the repo rate, and when the repo rate increases, the banks increase the interest rate, right? So if you go to the bank to take the loan, you will pay a higher interest rate. So the cost of financing increased suddenly, and there was another major event during this time. The rupee declined against the dollar. So people who have taken the loan from the foreign institutions at rupees 45 per dollar had to repay the loan at the rate of rupees 60 to 70 per dollar. So this was becoming a very costly affair. So because of these issues, the interest coverage ratio of these companies came down, which led to the stressed balance sheets in the corporate sector. And since these companies were not able to repay the principal amount or the interest in the scheduled manner, the income of the banks from these loans actually reduced. So the balance sheets of the banks also were stressed now. So there was a stress in the balance sheets of both the corporate sector and the banks because of this reason. So this is the flow of events. This is the entire chain of events which had happened, and this is the root cause of the present NPA problem or the twin balance sheet problem. Now let's move ahead. So economic survey says that yes, we are facing the balance sheet problem, but this is not new. Many other countries have faced this in the past, and many will be facing this in the future. But our balance sheet syndrome, our balance sheet problem is actually very unique, and they call it balance sheet syndrome with Indian characteristics. So how is it different? Let's see. So economic survey says that generally when this problem is observed in an economy, a few other phenomena are also observed. For example, the economic stagnation. The economy comes to a standstill. The economic activity comes down, and there is a widespread bankruptcy. A lot of big firms and medium firms will go bankrupt one after the other. So these things are actually not observed in India's case, right? So India's case is actually different. What has happened in India is economic growth was sustained even during the global financial crisis of 2008, and the phenomena of widespread bankruptcy was also not seen in India because the financial system of India has responded very leniently to the stressed companies. What the banks had done at that time, they adopted the strategy of give time to time. So instead of pressing the panic button, they provided further loans in hope that the businesses will eventually recover. So this was our uniqueness in the terms of twin balance sheet problem when compared to the rest of the world. So balance sheet syndrome with Indian characteristics. Here the same points are actually represented in the form of the graph. We can see that the restructured loan ratio was actually increasing from financial year 11 to 15, right? So a lot of evergreening of the loans was happening, and the companies which were actually stressed were again taking loans from the financial institutions in a hope that someday they will recover and they will repay all the loans. So this vicious cycle was getting kicked in where the companies were taking one loan to repay the other loan. And here the graph 2 shows the total stress on the banking sector. So there are three categories basically. So this color shows the gross NPA, and here you have the restructured NPA, and the red color shows the unrecognized NPAs which exist but actually they are not accounted as of now. Though we say that our NPA ratio is around 9.1%, but it may be actually around 15 to 16% if we see the second quarter of previous financial year. And if we observe the same statistics for the public sector banks on the right hand side, we can see that in the second quarter of financial year 2016-17, the total NPA ratio is somewhere around 20% of the total loans which were granted, right? So this is a very severe problem. So this is a graph representing the debt of top 10 stressed corporate groups in billion rupees. So we can see that by the years passing by, the loan accumulated in the top 10 firms is actually increasing with time, because what is happening, the loan which they are actually holding is attracting more loan. So they are taking more and more loan to come to a position where they can repay the loan, but that is not happening and they are taking more and more loans. So more and more amount is getting accumulated in these top 10 firms. And economic survey also says that twin balance sheet syndrome is actually a vicious cycle. So it is very difficult to come out of this, because what happens is there is a twin balance sheet problem in the economy, and we have seen why it is there, right? We have seen the root cause analysis, and because of that the business firms are financially stressed, right? They are not able to pay the principal amount, they are not able to pay the interest amount, and they are not profitable enough. So there will be a low level of investment, they will be investing less in the new projects and all, right? So there will be a slowdown in the economic growth. And the banks are also stressed, and banks are the institutions which feed capital into the economy, and capital is one of the requirements for the economic growth. So the cost of the credit is increasing with time because the banks are stressed, right? So even if businesses borrow, they have to borrow at a higher rate, right, at the higher interest rate. So borrowing cost is increasing for them, so automatically profitability comes down, and this again leads to slow economic growth, right? And the banks are not able to lend more, right? They have limited lending options now, so this leads to capital starvation in the economy. So firms are not able to innovate, they are not able to expand, so business expansion comes to a halt, and the investment to GDP ratio goes down, and this again leads to slow economic growth, right? And this ultimately leads to economic slowdown. Okay, and when there is economic slowdown, these firms will never come into such a shape that they will be able to repay the loans, right? So the twin balance sheet problem will continue. This is a vicious cycle, and it is very difficult for these firms to come out of this problem by themselves without any government intervention. So we will see that how government should actually intervene according to economic survey and what they have done in the past in this direction. And there is another interesting fact which is represented by this particular graph. So what is happening here is interest margins have increased significantly due to the twin balance sheet problem. And even when the RBI has announced a repo rate cut, the banks did not respond with a proportional interest rate cut, because due to the burden of the bad loans on their balance sheet, so they were not in a position to go for monetary transmission. And it was in news for quite a long time that the monetary transmission is not happening. So the margin between the repo rate and the bank interest rate was actually increasing with time. And the increase in the margin means that the performing borrowers and the depositors are actually being taxed in order to compensate for the non-performing borrowers, right? So that is what we can interpret from this particular graph. Now let's see what are the corrective measures which were employed so far, which were taken by the government so far. So these were some of the steps. First one was asset reconstruction companies. Their job was to buy bad loans from the banks and to recover these loans. But this scheme has seen only a limited success. Only 5% of the NPAs were actually overtaken by the ARCs, and very few of them were actually recovered. So this strategy did not work because the ARCs themselves were very hesitant taking up these bad loans. Then they came up with strategic debt reconstruction. Here freedom was given to the creditors, the people who have given the loan to the firm. They could actually take over the firm and they can sell it to a new owner, right, in a hope that the new owners will take it to a growth path. But even this thing did not work out, mainly because the big firms, they don't take loan from a particular bank, they take loan from different agencies, so they have a lot of creditors. Now all these agencies have to come together and decide that okay, we want to sell the firm and we have to sell the firm to a particular third party. So this decision was not happening with consensus, and because of that coordination issue, this strategy also did not work. And then again they came up with something new: sustainable structuring of stressed assets. So here creditors were actually given the freedom of reduction of 50% of the debt in the hope that this will restore the financial viability of the company. But this also did not happen because most of the debt was actually lying with the public sector banks, as we have seen. And in the public sector banks, the officers or the people who are responsible for making these decisions are they play very safe because of the referee institutions which economic survey talks about. They will never write down these loans because that will be seen as a favor to the private sector by these referee institutions and even by the public at large. Okay, so because of these constraints, these strategies did not work in the past. So okay, the previous schemes initiated by the government in this direction did not give the fruitful results, but economic survey has proposed something. So this is the beauty of economic survey: it always highlights the problems and it gives solutions at the end, and that is how your answers in the mains or your answers in the interview should be. Please highlight the problem but always give a solution at the end. So always try to end it on a brighter shade. So that is what economic survey has done. It has left us with a proposed solution. So it says that another agency called PARA is required, which is Public Sector Asset Rehabilitation Agency. So what it will do, it will handle the largest and the most complex cases, and very importantly, it will be the central sole agency to take care of the asset rehabilitation process, and a limited time frame will be given to complete this activity. And economic survey says that this is a time-tested solution. Many East Asian countries have actually adopted this after they faced a severe economic crisis in the 90s. And how is economic survey sure that this will be an effective solution? Because it says that this particular scheme will resolve many present issues. It says that the recognition of the stressed asset by the banks is not happening in time because the bank share evaluation will come down. They don't recognize these stress assets and they try to hide it. So that is not going to happen when a central agency is appointed to do the reviews. And the other thing is the coordination issue will come down, what we have seen in the previous slide. So this will be a single agency and the sole decision maker. So the decisions will be quick and they will be away from the political concerns. And it will be easier to write off loans in the eligible cases because it will separate the loan resolution mechanism and the concerns about the bank capital. So all these problems will be resolved with the help of PARA. So now let's have a quick recap what all we have studied here. We have seen the twin balance sheet problem. So what are the two balance sheets? The one balance sheet is of the corporate sector, which has taken huge loans and they are not able to repay, and the second balance sheet is of the banks who have given the loans and they are not able to recover the loans. So what are the repercussions here? The repercussions are NPAs are constantly growing and the investment and the credit growth is falling. Because of that, economic development is actually hampered in the long run. And then we saw the severity of the NPA issue. So there we studied some of the facts, like 40% of the outstanding loans are with the IC1 companies, the companies which have the interest coverage ratio less than 1. So they are not making enough profit to cover their interest repayment schedules. And then we saw that the public sector banks have around 12% of their lendings as NPA, and it becomes 20% if we include the unrecognized and the restructured NPAs also. And India's NPA ratio is higher than its peer countries, we have seen with the help of a bar graph, right? And then we saw what is the root cause analysis, how the things have gone wrong and what has happened in the past. So it says that a lot of loans were granted in the boom period, but what happened later was the projects got delayed and there was a cost overrun, because of which the debt servicing capability of the businesses came down. And now both the banks and the corporate sector balance sheets are actually stressed. And the problem is that this is a vicious cycle, so the companies or the banks cannot come out of this cycle by themselves. The government needs to intervene. So how the government has intervened in the past, let's see. So basically we studied three schemes. The asset reconstruction companies, so they are supposed to buy the bad loans from banks and to recover, but this was not successful because ARCs did not want to take too much risk. So then came strategic debt restructuring, where the creditors were empowered to take over the firm and sell it to the new owners in a hope that it will move along a growth path. But that did not happen because to build a consensus among a lot of creditors of the firm is very difficult. So because of the coordination issue, even this scheme was a flop. Then coming to the third scheme, sustainable structuring of the stressed assets. So here creditors were allowed to cut the debts by 50%. But the question is, who will well the cat? People don't want to take too much risk because they will be seen as favoring the private sector by the referee institutions and by the general public at large. Then economic survey has proposed a solution which is called PARA, Public Sector Asset Rehabilitation Agency. It will work out the largest and the most complex cases, and this has been time tested in the East Asian economies after they face the economic crisis. So that is all from our side, friends. If you have any questions or doubts, you can put in the comment section, and please subscribe to the channel. Please share these lectures with your friends, and you can download all these slides from our Facebook page. The link is provided in the description section below. So that's all for now. We will meet you soon with the chapter 5. Till then, bye bye, take care.